Hello, we will be working on Chapter 4, Completing the Accounting Cycle. Now, before I go into completing the accounting cycle, let's just reiterate some of the key points of the previous chapters that we talked about. One, we talked about the accounting as a whole, what it is, what it does, what it means to users, external users, and we're talking primarily about financial accounting. Two, we talked about organization, how to record transactions, what does it mean to post transactions, what are various accounts, what are their relationships to one another. We talked about double entry accounting. Remember, we talked also about accrual-based accounting and what does that mean, and what does that mean to the various transactions that you'll be looking at and you'll be reviewing. We also talked about the nature of long-lived assets and how the matching principle is used to adjust various accounts for accruals and deferrals. We talked about normal account balances. What is a normal debit balance? And what accounts are considered to have a normal debit balance? And what accounts normally would have a normal credit balance? We talked about assets and liabilities, what they are, how they're defined, and how they're recorded, and how they're increased and decreased. We talked about revenues. We also talk about equity as well, and what increases equity, what decreases equity, and the relationship between those various accounts using the accounting equation, assets equal to liabilities and equity. We talked about all of that, a lot of information in those three chapters. Today, we're going to finish our conversation about the closing process. Closing meaning the adjusting entries that you'll need to record. We've talked about how to record those entries, why is it important, and the type of things that you'll need to do to adjust those accounts, and ultimately preparing the adjusted trial balance. Today, we're going to talk a little bit about completing that cycle. And again, that's the purpose of this chapter, is what constitutes completing the cycle. And it essentially is preparing the financial statements and the closing entries. We want to first start with the income statement because that's important. That's the statement that has to be reported first. And you'll see as you're actually working through preparing these statements why it is important that the income statement is done first. The income statement purpose is to record or to show the net profit of the organization at a point in time, over a period of time. So it's going to show your revenues, and it's going to show your expenses, and it's going to show the difference between the two. And in the case of your project, you're going to see your revenues for your patent company and all your expenses that you generated from miscellaneous to supplies, etc. And then the difference is going to be the net profit. So it's going to be your revenues minus your expenses equals your net profits. That's the income statement. Your retained earnings statement is going to be important, but you need to have your income statement done first because the difference between your profit or your, in this case, your revenues and your expenses, your profit, that profit number is going to be the increase or decrease in your equity. So the retained earnings statement, which is going to be for corporations, is going to show the retained earnings at the beginning and the end of the period. So you're going to start with your retained earnings at the beginning. You're going to add or subtract your income, and you're going to take out your dividends. So for companies that are corporations and they pay dividends, dividends is going to be something that's going to be deducted from the retained earnings because you're no longer retaining it. So your balance sheet then becomes your final statement that I believe you're going to be preparing. I don't believe we're going to be preparing the statement of cash flows in this course. So we're going to ignore that for now. But for purposes of this, the last statement you're going to be preparing is the balance sheet. And the balance sheet really does work well with the whole accounting equation because on one side of it is your assets and the other side is going to be your equities and followed by your liabilities and followed by your equity. So it's basically the accounting equation in a statement. And what you'll be using is your adjusted trial balance clearly to compute your balance sheet. And again, it gives you your assets and you'll have your liabilities and then your retained earnings, and it's going to take all of your profit, if you will, and net it together to come up with your ending equity. So but your balance sheet really is going to show you a financial position as of a certain point in time. It is as of a specific date. And again, we're going to talk about our assets, our property, plant, and equipment. And in this case, when you divide them into two sections, you're going to say your current assets, which is going to be your cash, your accounts receivable, and your so forth. Then you're going to have your long-term assets, which is going to be your PP&E, your property, plant, and equipment. Liabilities are the same kind of thing. You're going to show them in two sections generally. Your current liabilities, which will be your accounts payable, possibly your wages payable, etc. And then you'll have your long-term liabilities, which would be your note payable and so forth. And again, here are examples of current assets. Make note of them. You will see them often, not only in your homework, but you'll also see them in some part in your project. Know what a current asset is. And a current asset is going to be within 1 year that can be sold or converted to cash. Very, very liquid, generally speaking. Your long-term assets are going to be something that's going to happen. You're going to have cash, but not necessarily within a year. Actually, it's going to be longer than a year. PP&E means, these are assets that they depreciate over time. They have long-lasting lifetimes. And it takes longer to sell them too. It takes a long time to convert them to cash if you needed to sell them. So again, these are going to be your examples. And again, these are not really hard. Just remember, if you can keep an asset on the books for longer than a year, if the asset takes longer to convert to cash, it's going to be a long-term asset. Current liabilities are noted here, and you'll see many of them in your project, and also you're going to see them in your homework. Just memorize what a long-term asset is and what a short-term asset is, and a long-term liability and a short-term liability. It's going to be that criteria of 1 year or less. And then long-term liabilities, and here's some examples. I would say note payable that's payable back in 2 years or longer than a year. And again, long-term is not necessarily a term that's not easy to understand. Something that's current, a year or less. Longer than a year, it's long-term. Again, the equity section is going to be the rights of the stockholders to the assets. It's going to show below the liabilities. And again, showing good form is very important in this course because there's a method to our madness. We accountants have a madness, and there's methods to this madness. And it all comes together when you see the proper presentation. Again, we talk about consistency principle. We're talking about being able to take your financial statements and compare with another industry. And again, these standards allows us to have the consistency and have this uniformity in how things are presented to the public for their decision-making process. And a balance sheet is one of those things where you really want to follow that process because you want it to be exactly the same format and structure as any balance sheet from any other company. And that's important. So again, knowing that the presentation of your assets and your liabilities and equities on your balance sheet is going to be important. That's the why of it. Permanent accounts are real accounts, and these accounts are carried over from year to year to year to year. They do not close. They are balances that are carried forward, and there are going to be many of those, and we know what they are. The assets are going to be the cash. It's going to be the accounts receivable. It's going to be the notes receivable. Those accounts carry over, and generally speaking, your permanent accounts are going to almost always be your asset, liabilities, and equity accounts. However, if you're going to have permanent accounts, you have to think about temporary accounts, and temporary accounts are going to be the ones that close after one period. They are not carried forward to year, and those are going to be your income statement items, which is going to be dividends, it's going to be expenses, and it's going to be revenues. These are closed out at the end of a period. So they start the next period with a zero balance. And how do we do that? We close them out. We transfer them to through a closing entry, which is going to be transferring these to the retained earnings, or in this case, the equity of your accounts. And as you know, we're going to close our revenue accounts because they are going to be temporary. They only have one period. And a period, in my definition, is going to be 12 consecutive months. Expenses are going to be closed and transferred to the income summary. So will be the revenue. And we're going to close out the income summary to our retained earnings account. And the dividends is going to be transferred to the retained earnings account. So we basically are telling you exactly what your journal entries will look like when you are at the point of closing your books. So income summary is definitely a temporary account, and it gets closed out. It's only for the sole purpose of transferring these revenues and expense accounts so they can zero them out, and thus they get closed out as well. And again, we are closing the books. We have prepared our financial statements. We are accurately prepared them. They are complete. They're done. And now we're ready to close out and reset to the next accounting period. So here are the steps that you'll be following when closing the entries. My suggestion would be to print out this copy just to make certain that you have the information that you need, but also you can refer back to it, because I'm sure in your homework you're going to be doing closing entries quite a bit just to get you to practice, because when you do it on your project it will be very easy to do because you know how to do it. Accounting in this course is going to be hinging on a couple of things. Your success is going to be whether or not you've read the material. You have to read your chapter. You have to. And in fact, I suggest you read it more than once. 2, you have to memorize and understand the terms that we're given. What is a post-close trial and balance? That's one term. Understand the terms. 2, understand the concepts. What is accrual basis of accounting? What is accrual basis of accounting and how does it affect you? Concepts, terms. And then finally, practice. Recording journal entries over and over and over and over again and various different types of transactions is going to be the critical key to success in this course. So now we've already closed our accounts. We are done. Now it's time for us to prepare our post-closing trial balance. And that is going to be a trial balance that only shows the permanent accounts. So your post-closing trial balance, you're going to see assets, liabilities, and your equity section. That's it. Your revenues and expenses will not be shown because they are essentially being closed out into the retained earnings. So the accounting cycle, and I would hope this should have been something we covered in chapters 1, but we're covering it here. What is the accounting cycle? Steps in the accounting cycle. You're going to need to know this. 1, you're going to analyze the transactions and possibly record them. You're going to post them to the ledger. And in this case, the ledger, we're going to call it our T accounts. You're going to record or prepare an unadjusted trial balance. You're going to make your adjusting entries, again, accruals and deferrals. And then you're going to post your end of spreadsheet. Now, that spreadsheet is going to be more automated if you're talking about a QuickBooks and other kinds of things. But you're going to analyze that. You're going to post your journal entries to your ledger. You're going to post your trial balance adjusted, meaning post all your adjusting entries, refoot your totals, and then come down to your adjusted trial balance. You're going to prepare your financial statements. That includes your balance sheet, it includes your income statement, and as well as your stockholders' equity section. Then you're going to close your entries. You're going to close your temporary accounts. Again, revenues, income summary, expenses, income summary, dividends, retained earnings. Close those accounts because they have one cycle of transactions and they do not carry forward. And once you've done that, you can prepare your post-closing trial balance and you start the cycle of step 1 all over again. Accounting periods, it could be a fiscal year. A fiscal year is month 1 to month 12. It does not follow a calendar year, meaning January to December. A fiscal year could be from July to June. It could be from May to June or to May to July. It's just 12 consecutive months, and that's most important. 12 consecutive months. So, and knowing these terms and understanding these terms are going to be important. They're not critical to understanding accounting, but you still should know them and understand what they mean in light of your accounting process. Now, decision making. Again, we always talk about ratios, and we talked about a few ratios in the previous chapters. I told you about solvency ratios, liquidity ratios, working capital ratios. We talked about ratios that shows profitability to equity, dividends to equity. All of these type of ratios, depending on what type of questions need to be answered, these ratios are quite relevant, and you'll see a number of them in your chapters. And using those ratios in the right way can really give you further meaning and depth to the financial statements you ultimately will prepare. And here are just some of the types of ratios: working capital, how they're calculated, and what they give, what information they provide. Current ratio is another. Again, if you want to know how well an organization is using its debt, a debt ratio will work. You want to know how liquid an organization is, you want to use their working capital ratio, etc. It depends on what you're looking for. And again, using a spreadsheet, we have Excel for this course because we're going to be using that worksheet to prepare journal entries and do all the other things. But working with a spreadsheet is an absolutely vital thing because you can do so much with worksheets and you can manipulate them very, very easily. But again, using Excel is going to be a part of your workbook that you'll be using to prepare your statements and etc. But again, using a worksheet for your end of period adjustments is an optional thing. but it's important to know how to use it. It does organize your work, and it does allow you to have a high level of accuracy. And again, because we're not using a customized software, we're going to be using Excel to prepare our financial statements. And again, getting familiar with the worksheet that we've provided you is going to be important. Reaching out for questions that you may have, and getting started early. So my suggestion is get started early on your project. Get familiar with it. Look at it. Understand the requirements of it. Work on the journal entries each week. Don't wait till the last minute. Ask questions now. This course has a lot of information that's being packed in front of you, and being organized and staying on top of your work is going to be essential to being very, very successful here. Although reversing entries is a part of the closing process, I do not believe you'll be required to record reversing entries in your project, but know what they are and how they're used, and basically why it's done. Again, this chapter is going to be very, very helpful to you. I am hopeful that chapters 1 through 3 have clicked, and now you're able to proceed forward with closing out your books. And I'll talk to you again in the next video.